Today on Money Talk, first, the Nasdaq hits 10,000, an all-time high. Second of all, is the stock market overvalued? And third, where do we go from here? Is it time to buy or time to sell? On Wednesday, the Nasdaq closed above 10,000 for the first time ever, an all-time high, which seems pretty crazy given that a lot of the country is still in coronavirus lockdown and a lot of major cities are still seeing protesting and rioting. And I wanted to talk briefly about the differences between indexes. So for example, in the Nasdaq 100 is what's called a market cap weighted index. What that means is the bigger the company, the larger the makeup of the index that company is. So for example, Apple is almost 12% of the index, Microsoft is 11.5% of the index, and Amazon is 10% of the index. So if you look at the top three biggest companies in the Nasdaq 100, they make up over 30% of that index. And those three companies I just noted are all actually continuing to grow even greater, even faster than they would before the coronavirus shutdown. So even though the Nasdaq 100 is making all-time highs, it's really just these three companies that are pulling it along. If you compare that to the Dow Jones Industrial Average, that's called a price-weighted index. That means the greater the share price, the bigger the impact that individual stock has on the index. So while the biggest holdings are United Health Group, Home Depot, and Apple, there's also big weightings to Boeing, Caterpillar, and American Express, which are companies that have been really hurt by the coronavirus, as opposed to the big tech companies, which have actually been helped by the coronavirus. So how the index is doing really has nothing to do with how the economy is doing. If you look at the small cap value index, which never makes it to the headline news, it is still down substantially on the year because a lot of these small companies are really struggling during the coronavirus shutdowns. So index performance is not indicative of economic performance. Now, the question we keep getting from all of our clients is the stock market overvalued? Should I sell? Should I buy? Can it go up from here? And it's a complicated answer because typically what the stock market does or what investors do is they look at the next 12 months of earnings and say, how much do I want to pay for those 12 months of earnings? So I'm going to throw some numbers at you here and try and make them seem a little bit clearer with what's on the screen. So typically, the stock market trades anywhere from 13 times next year's earnings to 20 times next year's earnings. That's a really big range. When you're in a bull market, it trades close to 20. When you're in a bear market, it trades closer to 13. That's kind of the typical range for the stock market. The 25-year average is 16.36. So that means if we expect the stock market to earn $100, so all the underlying companies in the stock market to earn $100, typically the S&P 500 is going to be around 1,600. With a range of 1,300 to 2,000. Now that's a lot of alphabet soup. So when you look at where the stock market is today, it's actually at 21. That means it's more expensive than its historical average. Well, doesn't that mean it's overvalued? It does if you're only looking at the next 12 months of earnings, but we know the next 12 months of earnings are going to be really bad because so many of our companies are still either shut down, like Disney theme parks or cruise ships, or severely hampered from doing business the way they like to, like airlines or restaurants or hotels. So a lot of investors are simply looking at 2021 earnings. And if you look at 2021 earnings and you give the historical market multiple of somewhere between 13 and 20, which is a big range, I admit, it tells us the stock market can reasonably be anywhere from 2,300 all the way up to 3,400. That's a really big range. So right now, if the S&P 500 is around 3,000, we're pretty close to the middle, maybe on the little on the higher side of that. Well, if you're a short-term investor, that provides a very difficult conundrum. Should I buy or should I sell? Well, it probably looks like the market's pretty expensive. If you're a long-term investor, it actually kind of solves that problem for you. If you can just accept that the next 18 months in the stock market could bounce around quite a bit. As we're sitting down to record this on Thursday, the market's down, I think, over 6%. We have no idea what's going to happen in the short term. But if you can just look out to when you'll actually need this money, 5+ years if you're in the stock market, the S&P 500 is a good buy today based on what we expect earnings to be 5 years from now. So if you can just take your head out of the newspaper today and the short-term numbers, we think it's still a good time to buy if you're a long-term investor. So with that huge range of investment options, what should you do? How can we help? Well, the first thing I'll remind you is that interest rates are expected to be near zero for the next 2 years. Back during the Great Recession in 2008, interest rates were actually zero for almost 7 years. Well, when interest rates are low, stock valuations go up. I won't get into the details of why that is, but we think it's a good time to own stocks when you compare that to bonds, especially if you have a long-term horizon. So if a typical conservative investment portfolio might be 50% stocks, 50% bonds, this might be a time that you want to look at adding more stocks than bonds to your portfolio. Second of all, the stock market, Nasdaq, as an example, is over 10,000. There are a lot of investments that are far below their all-time highs. We only talk about the stock market here, and that's really what they talk about on the evening news, but that doesn't address real estate. Real estate's been beaten up. That is a potentially good opportunity. And I say potentially because there's lots of different type of real estate. There's hotels, there's commercial buildings, there's residential buildings, there's raw land. One of the things we'll help you do is find the best real estate investment at this time, in our opinion. There's high yield bonds, there's municipal bonds. There are things that are good opportunities going forward that can fit into a well-diversified portfolio that it wasn't prudent to own in January, but now the world's changed so much that it might be a good time to buy some of those assets. If you'd like us to take a look at your portfolio or discuss some of the assets that you have, please reach out to us at denverwealthmanagement.com.